This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for gains after the US adds more jobs than expected in a sign of economic resilience. Treasury yields higher, traders scrapping bets on a Fed rate cut this month. President Trump securing his signature $3.4 trillion fiscal package of tax and spending cuts in time for his July 4th deadline. And the US Treasury Secretary dismissing concerns about the dollar's decline. Scott Bessent telling Bloomberg that the yuan or euro cannot take over as the world's reserve currency.
We could see a cautious start to the trading session across Asia. Of course, we do have another record high on Wall Street, but at the same time, President Trump now saying that they will begin sending letters to trading partners when it comes to unilateral tariffs. Not to mention that, of course, we continue to see some friction between China and the European Union on those negotiations between the two sides. And we are now getting the South Korean current account balance coming in at a surplus that widened to over $10 billion. This is a number that we're watching very closely. This data is for the month of June. Trade surplus also widening to $10.67 billion. But for last year, the current account surplus of South Korea against the United States was at a record high, which of course could be a challenge when it comes to South Korean officials trying to negotiate that trade deal with the United States. In the meantime, we'll continue to watching the JGB space in Japan because we actually saw JGBs tumbling. You can see Nikkei futures under pressure at the moment. All of this despite the fact that we had a solid 30-year auction, not to mention that we are coming off another solid 10-year auction. Perhaps a similar picture with fiscal concerns. Also, we had seen the Treasury market also slumping. Take a look at how futures are looking in the U.S. session because, of course, we had Treasury gyrations given that the jobs data came in better than expected. 147,000 jobs added, the unemployment rate also declining. Traders abandoning those bets that we might see a rate cut from the Federal Reserve this month. We did have a shorter trading session because of the holidays in the U.S., which means the reaction from that tax bill coming from President Trump that just passed the House, passed Congress, it's going to be signed into law. That reaction perhaps still not necessarily being seen. We are going to expect that next week, Heidi.
And in a lot of ways, quite surprising, right, Shery, that President Trump has managed to secure this sweeping shift in U.S. domestic policy. The House, as you say, passing his so-called big, beautiful bill that will cut taxes, funding for safety net programs, all in time for the July 4th holiday. Let's bring our senior editor, Derek Wallbank, who's watching all of this for us. And Derek, you know, we were looking at opposition from conservative hardliners to swing state moderates within his own party. So how did the president manage to overcome that resistance?
Well, there's a popular acronym that people use to describe the president when it comes to trade deals as TACO. Trump always chickens out, but it's really, you know, that's not the case when it comes to Congress. When it comes to Congress, what we have not yet seen is Republicans who say that they don't like something Donald Trump is doing, sticking with that in order to actually tank a serious policy priority of the president. This was Donald Trump's signature initiative. He said he wanted a bill by July 4th. He was a bit agnostic as to how that came together, but he said, I want the bill. I want to sign it by July 4th. And sure enough, Donald Trump says on True Social that tomorrow at 4 p.m. Washington time, there's going to be a White House signing ceremony for his big, beautiful bill, and that every member of Congress is invited to join there. This is a radical reshaping of basically the tax code. It also has some really key provisions in there about domestic spending. Overall, it comes in with a pretty significant price tag, about $3.4 trillion over the next 10 years. But it also takes a couple of fights off the table. One of them in particular is a potential debt limit fight that would have been, we would be gearing up for that in maybe about a month or two's time. That's off the table now thanks to a provision in this legislation. It's a very large piece of legislation. A lot of people are still going through it, trying to even see what is still in there at this time. But on the main tax provisions that Donald Trump ran on, those are pretty much included in here, and he's chalking this up as a signature win at around the 6-month mark of his presidency, the second time around.
And in order to pay for those tax cuts, we are expecting more than $1 trillion in cuts when it comes to federal spending on safety net programs, clean energy credits, not to mention that the Congressional Budget Office now thinks that 11.8 million Americans will actually end up losing their health insurance by 2034. How will all of this play with the American public in next year's midterm elections?
Well, Shery, that's really, I think, the biggest question that you have when you sort of look at this point. At this point in a presidential cycle, typically, you get to the end point of when we're doing serious legislation, and at some point we get to we're starting to look toward the midterms. I'm not saying that's happening right now, but I am saying you're starting to get into the window where in prior 2-year periods that would be about to happen sometime in the next couple of months. Now, both Republicans and Democrats said in the debate leading up to the final passage here that this was going to be the vote that they were all going to be remembered by. Democrats were using it as a threat. Republicans were using it as a promise. We'll see who's right or if it's a mix of those. But there are certainly some people in some swing districts who took some very, very difficult votes. Out here in California, David Valadao, for example, has the most Medicaid constituents of any House Republican. He voted in favor of this after being quite critical. There are other lawmakers who had said quite impassionedly in the last hours, literally hours of this fight, that they had big problems. They weren't going to support the bill. And in the end, all but 2 of them came around with no changes in the underlying text. I got to emphasize, no changes between when they said no and when they wound up voting yes. So let's see what people were promised. Let's see if any of that comes through. So there's a lot more to unpack here, but I do think politically both sides are saying right now that this is a win for them. That's just not mathematically possible. One of them is going to be wrong with serious consequences.
Senior editor Derek Wallbank there. Well, taking a look at the market reaction, because also had some key labour market data that played in there. Bonds falling, the dollar rising after stronger than forecast U.S. employment growth, easing concerns about the economy slowing down. 147,000 jobs were added in June. That's well ahead of the 106,000 estimate. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage here. And the Fed can kind of take the summer off and just wait and see.
Well, the Fed will feel very justified in its assessment, even going into this jobs number. You think of what Jay Powell and Raphael Bostic and Goolsbee and some of the others had been saying even before the jobs came in, that they didn't see any serious signs of concern coming from the labour market. And in that situation, with their ongoing concern about the impact from tariffs as potentially inflationary and something that should start to come through by the end of the summer, they were thinking they were going to be holding rates. And they turned out to be right. The jobs market numbers not only scotched the chances for July cut, but which were never higher than about 20 to 30%. They, more importantly, really made it clear that even September at this stage is not a sure thing. If you continue to get a relatively resilient jobs market, and if you do get any signs of some impact from the tariffs on inflation, then you would have to say September is in doubt. Where it is now, the Treasury market looks perhaps still a bit vulnerable to being ahead of the curve when it comes to what the Fed is actually going to do. And that's despite some, that jobs report was not stunningly strong. It was resilient. The drop in the unemployment rate owed a lot to a drop in the participation rate. There were some concerns about the lack of private jobs. It wasn't a strong jobs report, but it certainly was not a jobs report that signaled that the economy is heading into trouble. And in that case, with the uncertainties that the Fed has about what tariffs are going to do, they've said they would be holding, and they will be holding. And the bond market faces some concerns because of that.
Given the resilience in the latest eco numbers from the U.S., it makes you really think why you need such a large fiscal package, right? That will actually add, $3.4 trillion to U.S. deficits over the next decade. How much of that has already been priced in by the Treasury market?
Well, not a huge amount, but then again, there are all sorts of moving parts with this. One of them is we're all now waiting on these letters from President Trump and for some sort of resolution to what's going on in tariffs. There have been some clients who've written into us on occasions when we've expressed concern about what the deficit implications of the big beautiful bill would be, pointing out that they expect tariffs to make up for a lot of the tax cuts impact in the bill. So if they're right, then that would be a way to limit the damage, as it were, to the Treasury market. Though then the concern is what happens as far as, first of all, inflation, and second of all, as far as growth is concerned. Be that as it may, we came into this week with a lot of political drama going on, but I think Derek pretty much nailed it when he was talking about how Congress has been the one that's been chickening out on the domestic political side of things rather than President Trump. And markets were very much positioned for that. I think, as far as Treasury investors are concerned, this is probably, kind of what they expected, and an impasse, something that had led to the bill being postponed, would have been more of a concern, both because it would have left that debt ceiling situation unclear, and just because of the general uncertainty that would have created. The other thing that's going to matter is what actually happens going forward on the issuance front. Treasury Secretary Bessent overnight, I don't think, directly addressed this, but he did earlier on when he talked about the idea that if they are going to have to boost borrowing, they would tend to do it more when it comes to bills rather than longer dated debt. That might limit the impact on the Treasury market in the short term. In the longer term, that's going to be the major concern. As the bill actually comes into law, as we get the tax cuts that are being made confirmed, and in particular, we're going to have to look forward to next year, because the tax cuts were part of what it's doing is extending tax cuts that were already in place. So in a lot of ways, the biggest impact from the bill itself is going to be in the coming years, less so this year, although this year Treasury spending has been running more ahead of revenue than it was under Joe Biden. So that drumbeat of concern about the fiscal situation will remain. In the short term, probably more of a focus on what tariffs do and what they do to Fed policy.
Bloomberg's Garfield Reynolds there with a breakdown of course, all of the concerns around the U.S., including the trade tensions, not to mention the fiscal uncertainty. And in fact, because of that, we've seen a lot of pressure on U.S. assets. And Treasury Secretary Scott Bessent actually dismissing the idea now that the dollar's recent weakness is putting its reserve currency status at risk. Bessent told us that the Trump administration is taking steps to maintain the dollar's role.
The price of the dollar has nothing to do with a strong dollar policy. Current currencies move up and down based on a variety of factors, but a strong dollar policy means several things. One is what is the dollar strong against, or is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are. We are setting the stage for economic growth. We are constraining inflation. We are making the United States the best destination for global capital. And I think that's going to continue to happen. I think, as I said, many times over since World War II, The demise of the dollar as reserve currency has been predicted, and I think once again the skeptic's going to be wrong. But there is no change in policy.
Fair enough, but I'm sure you understand that the weakness that we've seen in the dollar to start the year is something we have not seen in decades. And there are other countries that have been trying to take advantage of it. In a speech just this week, we heard from the Chinese central bank governor, who really laid out at least their vision, their Chinese vision, for a new global currency order, which would, of course, mean a reduced role for the dollar and, in their view, a greater role for the yuan. Now, regardless of whether that is a viable plan, I am curious as to what you think about the idea that this is even being spoken about publicly.
Well, I mean, look, what are the Chinese going to say? And by the way, it's a complete fallacy. They have a non-convertible currency. So how are they going to be a reserve currency? They also have 1.4 billion people who want to get their money out of China. They have capital constraints on taking out money. The sine qua non for a reserve currency is that it trades freely. And I saw my friend Christine Lagarde, president of the ECB, the other day, said that maybe this is the euro's moment. But I can tell you, if the euro hits 120, Europeans are going to be squawking that it is too strong. They are an export economy. So let's see what happens. They should be careful what they wish for. Whereas in the United States, we recognize the responsibility that comes with being a reserve currency.
U.S. Treasury Secretary Scott Bessent there. More ahead here on the Asia Trade. This is Bloomberg.
Sources tell Bloomberg that Beijing may cut short an upcoming summit with European leaders as relations fray over trade and geopolitical issues. For the latest, let's bring in our chief North Asia correspondent, Steve Van Engel, in Hong Kong. And Steve, this was supposed to be a two-day summit, so not necessarily that long. What do we know at this point?
Yeah, we're hearing that the second part of that two-day summit, the EU-China summit, which is held every year, and that would invite Ursula von der Leyen and Antonio Costa, the European Commission president and the European Council president, to China, among others from the EU, July 24th and July 25th. 24th was supposed to be in Beijing, and the 25th, they were all supposed to be traveling down to Hefei, which is in Anhui province in central China, along with Xi Jinping and Premier Li Qiang. But because maybe tensions on the geopolitical front and trade tensions for sure have risen up, especially after some of the comments that we've heard from this individual, the EC president, Ursula von der Leyen, and also some concerns from the German leadership about those rare earth magnet export licensing process. We could see China possibly striking back a little bit by cutting down that meeting to just the Beijing leg, where it would likely then focus more on the geopolitical relationship between the EU and China, which, of course, Xi Jinping is trying to curry favor a little bit with the Europeans in face of this trade tension with the United States, no doubt. There's no surprise or no coincidence that the foreign minister, Wang Yi, is in Europe right now. He is having meetings in Brussels, in Germany, and in France. I would say it's probably a precursor and, setting the table for that EU-China summit, which is coming up in just a couple of weeks. But again, there are a lot of issues. Clearly, the Europeans are not happy with Beijing's support of Russia as the war in Ukraine goes on. Also, China's industrial policies. And again, China has struck back on those EV tariffs with anti-dumping probes into European brandy, dairy, and pork.
Perhaps not as many issues comparatively that Beijing has with Washington and vice versa still at the moment, despite the tentative truce. Is it possible that we could see President Trump visiting China?
Yeah, that's an interesting one as well. Again, sources are telling Bloomberg that Maybe some feelers are being put out by the White House or the Commerce Department, essentially to see whether some U.S. business leaders, top U.S. business leaders, would be willing to go on a proposed trip or a possible trip to China sometime in the fall, much like Donald Trump did when he went to the Arab states. He went to Qatar, he went to the UAE, he went to Saudi Arabia, and he brought U.S. business leaders, including Larry Fink, also Kelly Ortberg of Boeing, and others, including Jensen Huang of NVIDIA. And Howard Lutnick, we're hearing, is saying that maybe we could put together some sort of trip like that with that kind of high-level entourage to China. Big question is, when would that be? It could be in October because we have the APEC summit, Leaders Summit in South Korea in October, back-to-back with the ASEAN Summit in Malaysia. The other date could be in September when China plans to have a giant parade to mark the end of the World War II. But then again, that would be very weird optics up on the dais there above the Mao painting in Tiananmen Square in the Forbidden City to have Trump, Xi Jinping, and Vladimir Putin.
Chief North Asia correspondent Stephen Engel there. Well, President Trump says his administration may begin sending out letters to trading partners as early as Friday, outlining unilateral tariff rates ahead of the July 9th deadline for talks next week. Bloomberg's Min Min Lo joins us now for more. So, Min Min, what do we know in terms of this, I guess, being a prelude to the fact that President Trump has said that he wouldn't be extending that deadline? He doesn't actually think that it will be necessary.
Yeah, but at the same time, Scott Bessent, his Treasury Secretary, also said that Trump will be making unilateral decisions whether to extend those deadlines. Trump also at the same time saying that he's looking to send maybe about 10 letters a day to various countries to tell them exactly how much they need to pay in order to do business with the United States. And of course, you have countries like South Korea, Japan, the EU as a bloc also all trying to work towards a deal ahead of this deadline next week. And South Korea, for one, has said they are not sure they will be able to close a deal by July 8th. The deal with Japan, the talks with Japan has been going sour over those disagreements over rice imports and auto imports from the United States. And President Trump saying that he's looking to set maybe 35% tariffs on Japan. The EU trade negotiator is in Washington right now. Some reports saying that officials are maybe looking more willing to accept this 10% blanket tariffs in order to avoid that 50% tariffs that President Trump has threatened. And of course, China will be watching very closely for any sort of wording or terms that would undermine Chinese interests, especially when there are rule of origins requirements or even requirements on ownership structure as well.
And we may be headed towards the right direction when it comes to U.S.-Indonesia, a tariff deal between the two sides, because we're now seeing an investment pact. Will that help in getting to a trade deal that includes lower tariffs?
Yes, so U.S. and Indonesia seems to be making some substantive progress here. Both sides looking to sign an MOU on Monday, just a few days ahead of the July 9th deadline, that would have Indonesia commit to buy a certain amount of energy and agricultural goods from the United States in exchange for lower tariffs. Now, the final tariffs are not yet finalized, but Indonesia has said they are looking for a better deal than the one that Vietnam has gotten, 20% on local goods in Vietnam and 40% on transshipment. Indonesia is saying that the trade negotiator is saying the U.S. hasn't raised the issue of transshipment, which is a good news, but it also would then raise the likelihood of maybe Chinese exporters rerouting their goods through other countries like Indonesia to the United States.
Bloomberg's China correspondent Min Min Lo there. We do have more ahead. This is Bloomberg.
This is not a huge stimulus bill like the ones that we've seen passed in the last couple of years. This is maintaining the status quo for most of the tax code and doing some spending increases in the very near term and hoping for spending cuts down the road.
House Republicans do have a good track record of sort of coming in line where the president wants to be to get things done. And let's not let the perfect be the enemy of the good.
I agree with you on this bill. If you don't get it, then the tax raises take all bets off the table, and the market is absolutely expecting it to be a done deal.
So business investors and wealthy Americans are among the biggest winners in President Trump's tax bill. It includes $4.5 trillion worth of tax cuts, according to an earlier estimate from the Joint Committee on Taxation. The estate tax exemptions rises to $15 million for individuals, while the 2017 income tax cuts also become permanent. Meanwhile, those who hit the hardest include elite universities who face new levies, immigrants whose remittances will be taxed as well. Some of the costs are defrayed through cuts to Medicaid health coverage and food stamps, both of which benefit low-income Americans. Let's bring in Jeanette Garretty, chief economist at Robertson Stephens, to sort of delve into some of the economic impacts that we can see from this tax bill. So, Jeanette, good to have you with us. The whole argument from Republicans is that $4.5 trillion in tax cuts will eventually help grow the economy, sort of help really grow out of the deficit also that this adds onto the U.S. debt. Does this make sense?
It makes sense that it will be an expansionary impact on the U.S. economy, especially when one considers the timing, as we understand it, of the package, meaning that the tax cuts, the tax benefits come in early. They come in now and next year, and the benefit cuts happen later. So it is expansionary. The problem here is that we are, in the U.S., an economy that is already considered to be at full employment. 4.1% unemployment rate is associated with a pretty tight labor market, or balanced labor market, I guess I probably should say. So this is full employment. This is an expansionary bill. If you don't have to do much math other than to just look at the arithmetic of the deficit spending and the impact on the debt that goes up, that leads to expansion. This is kind of what is making monetarists, one of them being Jerome Powell, a little bit nervous, because in the longer run, it really adds inflationary pressure into an economy that could do without it. We'll put it that way. So that's one of the challenges. It will be a benefit to a lot of people. What Americans do, if you give them more after-tax income, is that they spend it. It helps a little bit with some of the chaos associated with tariffs, but it is going to be very challenging, I think, as this rolls through the economy.
I guess also my question is the distribution of the benefits and the burdens, right, of this tax bill, because in order to spend more, you need to cut somewhere. And the budget lab at Yale University saying that the bill would cost the bottom 20% of taxpayers an average of more than $500 a year, but then the top 20% would actually get a boost of more than $6,000. So when you look at how people spend money, it's a fact that poor people need to go out and spend everything that they get because they need to go through their daily necessities. Do rich people spend as much? And if we could pick and choose what we want to spend money and who we want to return money more to, does this bill tick the box?
Well, the thinking on that would be that rich people will invest the money. Rich people do a lot of spending too. Rich people will invest the money, investing the money in companies that will grow the jobs, and those jobs will be of benefit to everyone. That's the idea behind economic growth. There is a sort of fundamental near-term problem on the growth projections, which are very robust for the people behind the bill and a little bit more cautious for the rest of us economists. We think that given the labor force and the productivity that we have today, 2.5% is a good growth rate for the United States. There are assumptions being built in here for 3 to 4% growth. We just don't know how that's going to be achieved with the labor force that we have at present. Productivity can always go up, but in the very short term, that's a challenge.
There's also an expected almost 12 million Americans expected to lose health coverage, health insurance and Medicaid coverage as well, right? How do you expect that to play out when it comes to the blowout costs of healthcare?
That's going to be later. And I suppose there's some thinking that there could be some steps that would come into place to mitigate some of that impact, some of that at the state level. But there are already states who have said, I'm sitting in one today, Arizona, that has already said we do not have the ability financially to mitigate these Medicaid cuts on our populace. So that's just going to bear watching. And the administration, we understand, has been told that they feel that the impact of this will be de minimis. I personally am not so sure about that, but we're going to have to watch and see and hope that if it turns out not to be the case, people will step in and do something.
A lot of critics on the economy side say that the economic projections that have been put forward coming from the benefits of this bill are overly optimistic, right? What camp are you in, particularly against a backdrop of still a lot of ongoing uncertainty when it comes to the impact of inflation, what the Fed does, not to mention just a greater uncertainty over the US fiscal path and whether it continues to undermine the idea of, US financial asset exceptionalism?
Yeah, I think that's one of the things that hasn't been talked about too much. How are global markets going to receive this tax and spend package, the impact on the national debt? As we all know, there's a lot of pressure on the Federal Reserve to lower interest rates. But setting that aside, there's the question of what global markets will do to the 10-year Treasury, the 20-year Treasury, what the rating agencies will continue to have to say about that. Those interest rates are relatively high, certainly higher than some would like to see them be. And the question is, if they go up further, that will have a negative impact on growth and run counter to the intention of this bill.
Jeanette, going back to the fundamentals of the economy, especially after we got that strong jobs report, the surprise to the upside, we're talking about 147,000 for the month of June, jobless rate declining as well. You alluded to the fact that this, of course, tax bill could also add to inflationary pressures. Does the combination of all of this, plus the tax bill, plus everything that's happening, lead the Fed to delay rate cuts?
Well, I think the Fed is going to have a lot to digest. The employment numbers are very interesting. The unexpectedly strong growth, because the expectations were something closer to 100,000, if not maybe a little bit less, jobs created in June, mostly has been driven by state and local government employment. And there were a lot of state and local governments here in the United States that sort of said, you're going to get maybe laid off or whatever from your federal job, we'll take you because we have needs. And so there was a lot of shifting of employment. If one looked at just the private sector job growth was much more modest. However, with these numbers, there is a big issue, especially for the data-driven Fed that we have that says, show me the data and then I'll make a decision. We think there are problems with these numbers. If you are a business and you are asked to fill out the survey that is going to tell the Bureau of Labor Statistics what is going on with your new hiring, you got a million other things to do, including doing all the paperwork for all these tariffs. You're probably setting that survey aside and coming to it later. And that's why the revisions have been significant. So there is a lot of attention being devoted to other measures of employment. And this job number today does not mean that the number yesterday from ADP was irrelevant, because one must look at the ADP numbers from payrolls and say, wow, the trend there, different message, but it cannot be ignored. And that could indicate that there's a little bit more room in the economy to absorb the stimulus from this tax package that may free the hand for the Fed moving forward. We'll see. I think it's a 50-50 call, by the way, in terms of what the Fed does next.
And the Fed, of course, after July, we have the September meeting, and I think there are about 3 CPI reports that the Fed needs to see. That would be when it comes to June, July, and August. What are we seeing so far in terms of the trend, and given, of course, the passage of the tax bill as well?
You know, very hard to gauge. You're captive at this point to a lot of circumstantial evidence. In the purchasing managers surveys that have been coming out, when you look underneath the top line number, you are getting a message from manufacturers and service providers that their input costs are going up. It's been very quiet, but it seems to be there. The question is, what do they do in terms of passing that along to consumers? I think this third quarter is going to be very interesting. I think we're going to see a little bit slower growth than in the second. I think there is going to be somewhat greater price pressures than we have seen thus far. The question is how much. Right now, I think it's going to be modest, and the U.S. economy and the businesses and consumers in the U.S. economy can sort of continue to muddle through, in which case the Fed will continue to muddle through, and that might open up some opportunities that the Fed still says that they will, be inclined to cut interest rates before to the end of the year. We'll see.
Jeanette Garretty, Chief Economist at Robertson. Steve, it's always great to chat with you. And coming up next, the US reportedly considering now fresh nuclear talks with Iran. We'll take a look at how oil markets are taking all of this in. This is Bloomberg. Restrict the trade of Iranian oil. Both the U.S. Treasury, and State Departments announced separate sanctions on companies and vessels that help Tehran export its crude oil. Crippling Iran's oil industry, which is its top source of revenue, is a key goal when it comes to Washington's strategy. But the effectiveness remains in doubt. Data showing Iranian oil output still rising and flowing to countries including China. We'll take a look at what we're watching in crude markets at the moment as we continue to assess sort of fundamental supply and demand situations shifting, right, particularly with the readdition of supply from Saudi Arabia. OPEC Plus also is discussing that 411,000 barrel hike for the month of August. Those discussions have already begun, according to delegates who have asked not to be identified. Saudi Arabia and its partners had previously approved of those hikes of the same size for May, June and July, really reviving that halted output coming back on to try and reclaim market share. We are seeing pretty steady, just over $67 a barrel for New York crude. We're also seeing gold there trading about 0.2% higher, with futures looking a little bit softer. That strong jobs number from the US making the early Fed cut now unlikely, and we saw a bit of strength in the US dollar too. Let's get more on the OPEC Plus's ongoing discussions of a further hike in production in August ahead of the meeting this weekend. Our Bloomberg oil reporter Nicholas Lai joins us now from Singapore. So we've talked a little bit about the plan. Is it in line with market expectations?
Morning, Heidi. You're totally right. We've surveyed 32 traders and analysts here at Bloomberg, and we found that actually everyone's mostly expecting another 411,000 barrel per day hike. So these bumper OPEC hikes no longer come as a surprise. In fact, it's part of a bid that the cartel is doing in order to increase its market share of global oil markets.
And yet, of course, we do have the concerns over the Iran-Israel conflict, not to mention trade tensions adding to economic woes globally. So what are we expecting in terms of the price trend from here?
I would say that in the past 3 supersized hikes we've seen the morning after the hike, so the OPEC's planning to meet this Sunday, what's happened is we've seen oil come down at the open a significant bit. The first time this happened, the similar pattern has happened, but to a lesser extent over the last couple of hikes. But as you rightly say, the more broad picture is one that's much more uncertain. On one hand, indeed, I think the global oil demand is facing a much more mixed picture, as Chinese demand may not be as strong as we expected. And on the supply side, we are indeed seeing a picture that's much more supply heavy than maybe we predicted at the start of this year. Another thing to flag, as you rightly pointed out, is that the Iranian situation remains open, right? So Iran is a major crude supplier, and it's actually planning to be in talks with the US next week over its nuclear program. So I think these are all factors that could come in and weigh on prices in the coming days.
A potentially more maximum pressure campaign on Iran from the US, what does that have in terms of implications, both in terms of where Iranian oil can go, because we know that China remains a major market, right?
You're totally right. And again, I think what came in last night was like the sanctions, new sanctions on Iranian companies and the shadow fleet that's moving Iranian crude. And I think what this means is just that the picture's a lot more complicated. Because on one hand, like the US seems to be doing two things at once. It wants to reach a deal on the nuclear thing, but at the same time, it's also sanctioning the Iranian oil. And this is a problem this is a program that's been around for a while now. We've also seen that despite these sanctions, Iranian crude continues to flow. And so I think that's something to bear in mind, even as the headlines seem to point in one direction.
Bloomberg oil reporter Nicholas Lois there in the state with geopolitics, because Ukraine also now saying that its capital has come under a massive drone attack just hours after President Trump said his latest phone call with Vladimir Putin made no progress toward ending the war. The Kremlin also indicated no breakthrough, saying Russia will not back down on its war aims. Sources say President Trump is likely to speak to the Ukrainian president on Friday. Thailand's suspended leader Paetongtarn Shinawatra has been sworn in as culture minister as part of a cabinet reshuffle. The move allows her to attend ministerial meetings while awaiting a court review of her alleged misconduct. Paetongtarn announced the shakeup on Tuesday, hours before the Constitutional Court stripped her of prime ministerial authority. Sources say India may allow imports of some genetically modified U.S. farm products in a potential concession to secure a trade deal. New Delhi may agree to shipments of some products used in animal feeds, such as soybean meal. India opposes genetically modified corn and soybeans and forbids local farmers growing them as food, a stance that's emerged as a sticking point in negotiations. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how Japanese assets are setting up. We're less than 10 minutes from the market open here in Japan. We're talking about the Nikkei actually unchanged in the last session after two sessions of losses. We are now seeing the yen strengthening a little bit towards that 144 level, but still very range bound in the past few days. What we're watching was the JGB markets, because we had a strong 30-year auction, we had a strong 10-year auction, but we still saw yield surging. So we'll talk a little bit about that. But we did get Japan household spending numbers rising 4.7% from a year ago in May, and this was really above expectations. And we've already seen, of course, solid wage growth as well, perhaps helping on the spending side here in Japan. Annual wage negotiations now concluding with the largest pay increase in 34 years is an outcome that supports the BOJ's view that a cycle of higher wages and prices is emerging. Our Japan economy and government editor Paul Jackson joins us now for more on this, and this is such a crucial part of the BOJ's calculation of how they normalize.
Oh, absolutely. So I think this is a very encouraging figure. In a sense, it's not really a new figure, because we've known that the trend amongst the main union federation has been strong since March. This figure is a little bit lower than the 5.46% figure we saw in March. That's normal. It usually ticks down until we get to the final figures. So this certainly plays into the idea that the BOJ has room to keep raising interest rates. But, you know, there's a lot of uncertainty out there that must also be factored in. I think another thing we should note is that the household spending figure came in this morning, 4.7%. Could be a bit of a blip figure, maybe car purchases just slightly bumping up the figure. But still, I think we are seeing consumption trend picking up somewhat since the kind of dark days of 2023. So that feeds into the idea that the BOJ can keep raising rates. But, you know, I think the key problems that we have at the moment, we've got these trade talks with the US. We also have an election coming up later this month.
The trade talks, of course, a very big wild card, especially given that those negotiations seem a little bit stalled. But given the upper house elections that are coming up, how important are these numbers in the context of also cost of living is so high?
Well, I think
not so high. I should put that relatively against the world, not so high. But I mean, for Japanese people who've never seen inflation, right?
Absolutely, we've had a generation that's never seen prices go up. So this is something quite extraordinary that maybe the rest of the world is kind of used to, but not so much in Japan. And I think the key figures here is you've got core inflation going up 3.7% in the most recent figures. And yet if you look at the most stable benchmark of wages, which is like full-time pay for regular workers, you know, stripping out bonuses and overtime and stuff, that's going up at about 2.5%. It's a solid trend. It's a good trend. These are the steadiest figures we've seen in a long time. But it's not 3.7%. So if you've got 3.7 and 2.5, that equals cost of living crunch. And that's why that's the top issue in this election.
Right. So we have politicians now wanting to spend their way into office, which obviously kind of does not bode well for perhaps traders are looking at the JGB space and going like, fiscal sustainability. We had a strong 30-year auction, though.
Yeah, that's right. So, I mean, I think there's also some global factors that need to be considered here. We've just had this huge tax and spending bill passed in the US. I mean, these are huge amounts of money, huge figures that, you know, raise question marks about the fiscal situation in the US. Is that going to feed through to other markets? Absolutely. So I think if you look at the situation just in Japan, that 30-year auction went pretty smoothly yesterday. So I think that's a sign that policymakers in Japan have made some good calls in recent weeks.
Yeah, we had a strong 10-year auction as well, despite the fact that, of course, we have fiscal concerns globally, as you said, Paul, the U.S., and let's not forget even the U.K. gilt market turmoil that we also saw. Our Japan economy and government editor, Paul Jackson, we do have the market opens in Tokyo, Seoul, and Sydney next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens after another record high on Wall Street, not to mention, Haidi, that, of course, President Trump managed to pass that $3.4 trillion fiscal package that could boost the economy there. But at the same time, warning that he's going to begin sending letters to trading partners about unilateral tariffs.
Yeah, that's before you get to the fiscal concerns over that big, beautiful tax bill, as President Trump has managed to sort of get that political win ahead of the July 4th deadline, but a lot of uncertainty in terms of what it means for the broader economic outlook. We've also seen that pullback when it comes to Fed expectations, thanks to those jobs numbers overnight.
Yeah, so we could see a little bit of caution in the trading session across Asia as we see the Japanese yen rising a little bit against the U.S. dollar after weakness in the overnight session. And remember, Japanese stocks were just unchanged in the previous session. We had already seen 2 sessions of losses. You can see right now not a lot of movement early in the session as we continue to watch the JGB space. Of course, Haidi just alluded to the fiscal concerns in the U.S. Same thing over here in Japan. And we had a 30-year auction, a 10-year auction as well this week that were pretty solid, but we still saw JGB yields rising. Of course, concerns around where debt goes here in the country is also big among traders. But at least when it comes to household spending and perhaps some of that virtuous economic data out of Japan seems to be pretty strong. We saw household spending now rise 4.7%, and that really coming in above economists' expectations. And also the annual wage negotiations in Japan leading to the biggest pay hike in more than 30 years. So how that virtuous cycle continues in the Japanese economy, a key question for the Bank of Japan. Take a look at how Korea is also coming online, because we had the Kospi gaining ground in the previous session, but the Korean won under a little bit of pressure. Take a look right now. 1362 is a Korean won at the moment. We had seen the current account surplus for the month of April widening to top $10 billion. And at the same time, of course, we have to keep an eye on that figure, especially against the United States, because for 2024, South Korea saw its largest current account surplus on record, which, of course, Haidi brings more challenges when it comes to trade negotiations with Washington.
And those challenges are just going to sort of become heightened as we get closer to that July 9th, the deadline next week, right, Shery? Take a look at how we're setting up in that staggered start to trading here in Australia. We didn't have much of a session in sort of either direction on Thursday, and that looks like how we're starting off the day today here as well, just up about 0.1% there. We're likely to see that sort of Australian bonds really following the direction that we saw in Treasury. Still a lot of consternation when it comes to the longer end of that story, of course. And the Aussie dollar actually, interestingly, holding on to some of those gains despite what we saw was a bit of a boost to the greenback overnight alongside yields, given that we did see both the jobs numbers sort of surprising to the upside, some of the Fed expectations being unwound, and that tax and spending cut bill being passed as well. Let's bring in for some analysis now in terms of implications for the markets. Here in the Sydney studio is Tony Sycamore, who's a market analyst at IG Australia. Tony, always great to have you with us. There's still a lot of uncertainty, right? I mean, certainly now the move kind of that was always an outlier from the Fed in July has been pushed out of the way.
Yes. I have to agree. I mean, there is still uncertainty out there, but one thing we do know is the US economy seems to be holding up relatively well. There were concerns in the lead up to last night's non-farm payroll data that we might see that unemployment rate spike to 4.3, possibly even 4.4%. All the labour market indicators, bar jolts, were suggesting there was some weakness inherently in the labour market. But with that drop in the participation rate, we actually saw the unemployment rate fall to 4.1%. And the headline number, the larger than expected job gains, the unemployment rate dropping, that's the number which people are going to remember in the weeks ahead. And at 4.1%, there's not too many concerns from that perspective.
What is sort of opportunistically interesting to you at this point then?
Well, to me, it's remarkable just how quickly Trump's bill passed. I think the base case there was it would be August, potentially September, but it's the speed with which it's passed through Congress to land on his desk for signature later today is extremely impressive. And I don't think the market's probably fully got hold of that at this point of time. So I see that as providing a boost in the weeks ahead because the timing, as we mentioned, was further back. It does remove some uncertainty. We speak about uncertainty. It does remove that uncertainty with regards to the debt ceiling, and that's headlines which we're not going to see, thankfully, again this year, pushed back until next year. And I guess in terms of the next big thing for markets is what happens with the July 9 reciprocal tariffs deadline. And you heard Trump coming out saying we're just going to send letters. I think potentially before that deadline, we see a trade pact, if you like, with India and potentially Europe. But others are certainly showing less inclination to proceed. Japan and South Korea, for example. And I think that's just a case whereby it's a 10% minimum tariff, potentially up towards 20%. And we'll deal with that as we see how it unfolds next week.
Are there any sectors in the market or even just geographies that you could hedge this volatility?
Absolutely. I mean, I think the core holding or the core view is that US equities and global equities, in fact, have taken on board a lot of bad news, and the rally from the April lows has been imperious. The pullbacks have been shallow, they've been well supported, and I think given the fact we've broken to new highs, given the fact that the US economy looks like it's holding up relatively well, given the fact we have this tax bill offsetting some of those tariff concerns, US equities can continue to rally into year end, albeit on elevated volatility given the fact we still have those uncertainties. As the hedge to that tail risk, which may come from something we are not yet aware of, I think the gold story remains very solid. In terms of the dips lately, it's been well supported down towards 3,150-ish, 3,250-ish. So I think that level will hold and we can see a push to new highs into year end. Bitcoin, as another point of where there is opportunities, that correction which we've seen from the 112,000 high down to the recent pullback low around that 98,000 area, it was very, very orderly. Again, there was a lot of bad news and it held together very, very well. And here we are, we're knocking on the door of record highs up around that $112,000 area. $112,000 area, sorry.
Tony, Where do the traditional havens like sovereign debt rank in this whole hedging situation? Because at the same time, we have so many fiscal concerns, whether it's the U.S. or here in Japan. Even with strong JGB auctions, we have seen yields continue to rise.
Have to keep watching the JGB yields. That's certainly something we need to be mindful of, as well as the long end of the US yield curve there. With that bill passing, with the extra debt which it brings, the market hasn't really had an opportunity to vote on that yet, in my opinion. So obviously the short end of the yield curve pushed up about 10 basis points overnight. The 10 years and the 30 years seem relatively well behaved at this point of time. So it's not something which we need to pull the trigger on right now, but have to keep an eye on those things, because that is probably where the bigger concern is. And also with regards to the US dollar, there's still some obviously concerns with whether people want to remain overweight US equities to the same extent they have been. Does that mean that we're going to see more hedging from portfolio managers, reducing their exposure to the US dollar? As Haidi mentioned earlier, the Aussie's holding rock solid at 65 cents. And I think there's certainly concerns from the Australian portfolio manager community whether they should be lifting their hedges with regards to buying the Aussie dollar. And if they do make small adjustments to their hedging ratios here in Australia, that equates to billions of dollars of Aussie dollar which needs to be bought. So these things need to play out over the coming weeks, but certainly the long end and sovereign debt needs to be monitored.
Do you think there is complacency in this market at the moment? I mean, obviously the taco trade had kind of people believing that the worst is over when it comes to tariffs.
There is complacency, but I think that comes from the fact that we have just continually climbed this wall of worry. There's been, we've had 2 weeks ago, there's been US bombers flying over Iran. Crude oil spiked to $78. And by and large, the markets remained relatively well behaved. So this complacency comes from the past behaviour. Now, the question is, we still have, in the White House, President Trump brings volatility to markets. So whether we're now decided that we look past that and the worst is behind us, as we mentioned, the fact that that bill passed so quickly is a great sign. Bessent's talking about growth trajectory, hitting that 3%. Things could potentially have closed the chapter on that very rocky start to the first half of this year. And seasonally, of course, July is a good month for equities. We know that the Northern Hemisphere summer's well underway. Here in Australia, school holidays are well underway, and in other places. So it does generally see equity markets track in the path of least resistance, which is higher. So at this point of time, if the complacency is shattered, I don't think it's going to be till late August, potentially September.
Tony, always great to have you with us. Tony Sycamore, who's a market analyst at IG Australia. More ahead on the Asia trade. This is Bloomberg.
This is not a huge stimulus bill like the ones that we've seen passed in the last couple of years. This is maintaining the status quo for most of the tax code and doing some spending increases in the very near term and hoping for spending cuts down the road.
House Republicans do have a good track record of sort of coming in line where the president wants to be to get things done. And let's not let the perfect be the enemy of the good.
I agree with you on this bill. If you don't get it, then the tax raises take all bets off the table, and the market is absolutely expecting it to be a done deal.
Some of our guests on the passing of President Trump's tax bill. For more, let's bring in Bloomberg editor John Herskovitz. And John, of course, Republicans say that this $4.5 trillion tax cut will actually help grow the economy, but it's not going to benefit everyone. Democrats might be able to use this for the midterm elections.
Exactly. And Republicans are seeing this as something that, as you said, will benefit the economy, will help businesses. And Democrats see this as something quite different. They see that this is going to hurt some lower income Americans. We have about $1 trillion in cuts to Medicaid. We're seeing some cuts to food provisions and also student loans. A lot of things that are going to hurt a lot of people. The Congressional Budget Office has said something like 11 million or more Americans are going to lose their health care over the next decade. And also you're talking about the debt this is supposed to add about $3.3 trillion to the debt over 10 years, which could hurt mortgage rates. It could hurt long-term borrowing. So there's a lot going on. There's some people who will benefit, and a lot of people who are going to find themselves in a much more difficult position.
Yeah, you mentioned some of those losers, including the lower income people, especially when it comes to health insurance. So who are the biggest winners and losers from this tax bill?
We'll see wealthy Americans will have a greater tax, will have greater tax cuts. Estate taxes are going down. Businesses are going to see some cuts on R&D and investment. We're going to see some work with tips, and so on that end it's one thing. On the other end, we're going to see some things like EV provisions, which would help grow the electric car industry. Those things are going away. Clean energy is going away. We're seeing that universities are going to find their endowments taxed a little bit more. So it's going to affect all aspects of America in a lot of different ways. It's a big chunk of money that's involved here.
Yeah, of course, we know Elon Musk really not happy with those cuts on EV credits. But when it comes to a large majority of Americans, we're talking about estimates that could lead to 11.8 million Americans losing their health insurance by 2034, according to the Congressional Budget Office. What are the key provisions here that could really make a difference?
Yeah, I think what we're seeing with the Medicare cuts, the Medicaid cuts are going to hurt a lot of people in a lot of red states who depend on these, along with the food assistance. And also Americans, for the most part, just aren't on board with this. Polling ahead of this showed that Pew Research polls showed about 50% didn't approve, 30% did. A Washington Post Ipsos poll put the disapproval rate even higher. So as these cuts start to take effect, on Medicaid and other things, you're going to see a lot of Americans affected, and this is going to be a key factor. The Democrats will. It'll be a key factor in the midterm elections next year.
Bloomberg's John Herskovitz here with a breakdown of course, that tax bill that President Trump managed to pass through Congress. And also what's going to affect Americans is, of course, the tariff situation. President Trump saying that his administration could begin sending letters to trading partners as early as Friday, outlining unilateral tariff rates ahead of the July 9 deadline for talks. Bloomberg's Min Lo joins us now with the latest. What are we expecting on these unilateral tariffs that come also, as I mentioned, ahead of that supposed deadline where the pause on those blanket tariffs would actually be raised?
Yes, I guess everybody is waiting anxiously for that letter. Is it going to come with a big number or a deadline extension? Because Scott Bessent, the Treasury Secretary, had said that President Trump will unilaterally decide whether or not to extend those deadlines. And look at how the talks have been going. South Korea is saying they're not confident that they will be able to reach a deal by July 8th. Japan, those talks going sour over disagreements over whether to import rice and autos from the United States. And President Trump saying that he might impose 35% tariffs on Japan. The EU is also trying to get to a deal, the EU trade negotiator in Washington right now, and it seems like officials are looking more willing to accept that 10% blanket tariff in order to avert the higher 50% tariff that President Trump has threatened. But of course, China will be watching all of these very closely for any sort of phrases or terms that would undermine China's interests, especially if there are requirements on rules of origin or ownership structure or a tiered tariff level that could target Chinese transshipments as well.
When it comes to negotiations with other partners like Indonesia and India, we might be seeing some more progress?
Yeah, so Indonesia is close to signing an MOU with the United States on Monday, committing to buy a certain amount of agricultural and energy goods in order to lower tariffs on Indonesian products. But the final tariff rates have not been determined yet. Indonesia is saying it's hoping to get a better deal than the one that Vietnam had gotten, which is 20% tariff on local goods and 40% on transshipment. The Indonesian trade negotiator has said that so far the U.S. hasn't raised the issue of transshipment in Indonesia. So it'll be interesting to to see whether they will get a tier tariff level or not. But if they don't, it is possible that Chinese exporters will then find a way, alternative way to reroute their products to the United States through countries like Indonesia. And meanwhile, India as well, looking like they might be prepared to accept some painful concessions, especially when it comes to GM crops, possibly accepting GM animal feed. And we know that India has been pushing hard against the shipments of GM soybeans and corn from the United States. There are very strict rules in India to prevent cultivation of food for human consumption that uses GM seeds. And of course, there is a huge agricultural sector in India. They represent a very big voting bloc. It's a very fundamental issue there when it comes to rural livelihoods and food security. But it seems like the stakes are pretty high given that Bloomberg intelligence is saying without a bilateral trade deal, India could be sacrificing as much as a 90% rise in exports over the next decade. So it looks like they might be prepared to accept some GM animal feed for now.
Bloomberg's China correspondent Min Min Lo there. Well, sources are telling Bloomberg that Beijing may cut short an upcoming summit with European leaders as relations fray over trade and geopolitical issues. For the latest, let's bring our Chief North Asia correspondent Stephen Angle, who joins us in Hong Kong. So we have seen, some readouts and commentary from the Foreign Minister Wang Yi, who's been in Europe this week. What do we know about, I guess, how well that went and the fact that we're now seeing potential uncertainty over the EU-China summit?
Yeah, I'm going to bet that Wang Yi is in Europe for a 7-day trip where he's going to Brussels and he'll be in Germany talking to German leaders and also in France. He's kind of setting the stage for that EU summit, which is coming up in a couple of weeks. The EU-China summit is scheduled for Beijing and Hefei in central Anhui province. It's not scheduled, so to speak, because the Chinese officials haven't necessarily confirmed those dates, but it's widely believed to be on the 24th in Beijing and the 25th in Hefei. Now we're hearing from sources that the Chinese are going to pull back or are proposing to pull back, cut it in half and not do the Hefei part of the trip and just do Beijing. So Ursula von der Leyen, the European Commission President, and also the European Council President, Antonio Costa, among others, were expected to lead the European delegation to China. Still likely to do that as well, but just have meetings with Xi Jinping and Premier Li Qiang in Beijing. What we're hearing is that there are obviously some trade issues, some geopolitical differences between the two sides that have bubbled up, while at the same time, of course, Beijing is clearly trying to court the Europeans at a time when they are having these trade difficulties with the United States. But Beijing is also concerned that any negotiations that the EU is having with the Trump administration for their trade deal might put China at a disadvantage. That is something the Ministry of Foreign Affairs and the Commerce Ministry in China has expressed their concern about, warning other nations not to negotiate with the United States on their own unilateral or bilateral trade deals at the expense of China. So there's lots of moving parts here. Obviously, the Germans and the Europeans as a whole are concerned about the export licensing process, the slowness of that coming from China because of rare earth batteries. There's obviously still ongoing EV disputes. There are anti-dumping probes launched by the Chinese on dairy, pork, and brandy from Europe. So there are a lot of contentious issues that are not going to be resolved actually by cutting back the EU-China summit in half.
And Steve, as we speak right now, President Trump in Des Moines, Iowa, and he's about to deliver a speech, Salute to America. This is the Iowa State Fairgrounds, and this is supposed to kick off a year-long festivities leading up to the 250th anniversary of the signing of the Declaration of Independence. And of course, a very celebratory event as President Trump just also passed that $3.4 trillion fiscal package through Congress, a huge economic victory for him. We know that this affects Americans in different ways, but the House voting 218 to 214 to pass the legislation, which will add $3.4 trillion to U.S. deficits over the next decade. You can see President Trump there is basking at that rally again in Iowa. awaiting that speech for him to start that 250th anniversary of the signing of the Declaration of Independence. And Steve, this, of course, as he continues to negotiate with the likes of China, a very challenging front, because we know that they do have a Geneva framework in place. But will this move forward with more concrete steps? And could we potentially see President Trump in Beijing at some point?
Yeah, well, that's what we're hearing from White House officials speaking on anonymity, that they're possibly lining up a trip to China sometime in the fall, and that they are possibly trying to elicit what names that could go with him as far as business leaders. We do know that he went to the Gulf states, including Saudi Arabia, Qatar, and the UAE on one of his first trips as president. He brought along Larry Fink, Kelly Ortberg of Boeing. He brought along Jensen Huang of NVIDIA. It looks as though Howard Lutnick, the Commerce Secretary, is envisioning a similar type of entourage to go with him to Beijing. The big question is, will the hawks in Washington derail that? And also, when would it be? Would it be at the same time as the APEC summit in in South Korea in October that goes back to the ASEAN summit in Malaysia? Would it be as early as September, when Xi Jinping is planning a big military parade for the anniversary of the end of World War II that Vladimir Putin has also been invited to? That would make for very odd optics up there on the dais above the Mao portrait at the Forbidden City in Tiananmen Square, with Xi Jinping, Vladimir Putin, and potentially Donald Trump waving to the crowd and to the parade of military armaments.
Our Chief North Asia correspondent, Stephen Angle there. We do have more ahead on the Asia trade. This is Bloomberg.
In American history, the largest spending cut in American history, the largest border security investment in American history, although I must tell you, if you saw last month, they had 0 people coming through our border, 0. I'm not sure that's even possible. You know, I'll take it, but somebody must have got to. The other character had hundreds of thousands of people every time. Sometimes in a day, they'd have over 100,000. We had 0, I don't know, for the month. So it must be a little wrong. Maybe they're 2 or 3 or something, but I'll take the 0. And the group that makes up those stats, you know, they're radical left Democrats, so it's probably true. We did a great job on the border. The largest welfare reforms and military upgrades in modern times, that's what we're doing. We rebuilt our military in 2016 in their first term. We rebuilt it. They gave some of it away to Afghanistan on the most embarrassing day in the history of our country. You remember that? We remember that? We don't have days like that. We have days like we just had in Iran. That's the kind of days we have. Complete obliteration. It turned out that was complete obliteration. Think of these guys flying way up in the air on a dark night, no moon, no nothing, and they hit every single target. It's the size of 1/2 a refrigerator door, a little size, 2 by 2. But this is a declaration of independence from a really national decline. We had a national decline. We were a laughing stock all over the world. We had a man as president who shouldn't have been there. You know that. He shouldn't have been there. But we really had independence now over the, if you look at it, the overtaxation, where we were being taxed out of our lives, independence from overregulation. We have independence now from radical left bureaucrats, and independence from the largest alien invasion that I think any country has ever seen. We've never had anything like that. These people were fools. They allowed it to happen. You know, we've already cured inflation. Your gas prices are way down. Everything I said is done. But the one thing, it's hard. It's hard. Think of the time we spent on having murderers and gang members and prisoners from all over the world come into our country. We're getting them out fast, but it's a terrible thing what they've done to our country, and I hope you remember it, what they've done to our country, our beautiful country. 11,888 murderers came into our country, and some we've already gotten out, but it's terrible. Many of them, more than 50%, murdered more than one person. Can you believe it? and they let them come into our beautiful country. Just as I promised, we're making the Trump tax cuts permanent and delivering no tax on tips, no tax on overtime, and no tax on Social Security for our great seniors, right? Front row Joe. We got a lot of front row Joes here. That's very nice. Thank you. Thank you. And we have Mr. Wall. Someday I'm buying that suit, I'm telling you. I like that suit. I'll walk up one day, I'll be dressed like a Wall, just like you. I think he's come to about 200 rallies, and that means you like us. And I think he's a very successful guy, too, believe it or not. He's a top accountant. Can you believe this? And he comes to rallies, he likes the rallies. Front row Joes, they're all successful. But this is what they do for entertainment. But now it's not entertainment. We've saved our country. We've got the hottest country anywhere in the world, as said by many, many leaders of other countries. And we will ignite trillions of dollars in economic growth, increase take-home pay for the typical family by more than $10,000 a year. And very importantly for Iowa, this bill rescues over 2 million families.
President Trump there speaking at the Salute to America speech at the Iowa State Fairground. He's just arrived there. This is seen as a kickoff event for the year-long festivities leading up to the 250th anniversary of the signing of the U.S. Declaration of Independence. He's in there in Iowa, in Des Moines today at that rally, sort of covering a range of topics, including, of course, his signature immigration and deportation campaigns, but also talking a little bit about that $3.4 trillion fiscal package that passed the House, Shery, despite, of course, concerns about opposition from really a lot of different positions on the political spectrum.
Yeah, what he calls a welfare reform, of course, $1 trillion in federal spending cuts when it comes to safety net programs. Let's take a look at how commodities are trading at the moment, because we are not seeing a lot of movement when it comes to some of these metals trades. We continue to watch copper because we saw it rally to that 3-month high and then actually falling below that $10,000 level a ton in London. Of course, it's really a lot to do with the concerns about the demand outlook. Similar picture for oil, because we are expecting that OPEC Plus meeting that's expected to result in another large production hike. Let's bring in Vandana, founder of Vanda Insight. So, Vandana, what should we be expecting from that OPEC Plus meeting? The consensus seems to be 411,000 barrels a day production increase for August.
Yeah, good morning, Shery. That indeed is what the market is baking in, which would be the fourth successive month of an accelerated unwinding of the cuts. Another 411,000 barrels per day in August would leave them short of returning that entire 2.2 million barrels per day by just another 411 or so. So which means another similar hike in September, and they would have completed returning all of the 2.2 million barrels per day back into the market a whole year ahead of what they had planned initially as part of their gradual phase-out program.
Does that mean more pressure for crude prices after that rally we saw on geopolitical tensions in the Middle East?
So, yeah, I do feel, first of all, addressing your point on the geopolitical tensions, I think that's a bit overbaked. We saw Brent jump up around 3% or so after news broke out that Iran had put some conditions on how or whether it would continue cooperating with the IAEA. So I do expect that to go, because I think the market overreacted. I think that we have plenty of evidence now. The market has seen that, rhetoric and threats of whatever that typically come from Tehran do not translate to supply disruptions. So couple that with continued increase from OPEC Plus. It's mostly baked in, but it is a drag on sentiment. I think we will probably see Brent return to its more what I call comfort zone of 64 to 66. It's sitting a little above that for the time being. I don't think that prop is going to last.
The renewal of the maximum pressure campaign on Iran from the US, does that have implications for the markets?
We are seeing mixed signals from the US, which is again typical of this sort of, I think, another round of posturing now going on. Will there be a nuclear deal or won't there? Is Iran going to cooperate or is it conditionally cooperating? I mean, there's a whole lot of confusion in the market. The latest headlines I saw were suggesting that the US is looking to resume talks with Iran, and there have been the sort of similar comments out of Tehran yesterday as well. Look, going forward, I think even Trump should know that the pause, the ceasefire is just that. It's not a solution. It's not a formula for lasting peace in the region. So, he may have said that, well, we probably don't need a nuclear deal because nuclear facilities in Iran have been obliterated, quote unquote. But I think the world knows, and probably I suspect so does Trump, that it's far from the truth. There has to be some sort of a drawing a line under this for the markets to have some degree of certainty that Iran's going to behave in a particular way with regard to its nuclear plans, and the US is going to respond to it, with whatever it does with the oil sanctions. So that is a big fog right now for the market. I think we will see some clarity in the coming months.
How much clarity when it comes to the demand side? Because we've had some fairly encouraging jobs data, at least out of the US, sort of underscores this narrative of at least that resilience holding up. Is it still going to kind of end up being more of a supply side story, though, when it comes to what drives these prices?
Yeah, it's interesting, Heidi, the decoupling that we see between the US stock markets, the risk appetite, whether it's stemming from sort of ease over the trade tensions, anticipation of some trade deals starting to make things better, or the Fed probably starting to cut rates, and then, as you mentioned, resilience in the US, inflation coming down, resilience in the jobs market. That optimism is not being reflected in oil, and a big part of that reason is that one is, of course, the expectation that there's plentiful supply because OPEC Plus is continuing to accelerate its unwinding. And the second is that demand, even if all of these things improve a little bit on the trade front, on the inflation front, on Fed perhaps starting to ease rates a little bit, it's not going to do much for oil demand. So oil demand growth outlook remains quite downbeat, and I don't expect that to change. So irrespective of what happens on these fronts in the coming weeks on the trade tariff deals and the Fed rate cuts, I do not expect the market to change materially its outlook for the balances, and does look like a little bit of an oversupplied market going into the second half of the year.
Vandana, always great to chat with Vandana, who's the founder of Vanda Insights. We have more to come here on the Asia Trade. This is Bloomberg.
I was in Saudi Arabia, I was in Qatar,
President Trump's America First agenda has opened the door for BRICS to challenge the U.S.-led global order. Bloomberg Originals explores the rising economic and political clout of this bloc of major developing economies and whether it can truly unite as a counterweight.
This is a story about how the world's most powerful, richest country is slowly losing its influence.
And it's evident here.
We can see across Brazil, thousands of Ford cars almost disappear.
Meanwhile, China's BYD is becoming increasingly common.
Ford left a plant abandoned. BYD, they modernized the plant. They are now producing electric cars from Brazil.
It's evidence of the growing connection between Brazil and China, the B and the C of the BRICS Plus coalition. This is a group that hopes to rival the US-led G7.
The most important emerging economies in the world are the four BRICS: Brazil, Russia, India, and China.
My fellow Americans, this is Liberation Day.
This mantra,
America first,
has created an opening.
The trade war increased the solidarity between BRICS nations. The BRICS are now emerging as really the only global forum that can stand up to Trump's trade war.
There wants a multipolar world in which there are multiple centers of geopolitical influence.
But can these countries unite to become a meaningful global force? To answer this, it takes an understanding of how economic power collided with circumstance, and whether the group can overcome some big hurdles. But first, the acronym BRIC was coined in 2001 by Jim O'Neill, who at the time was an economist with Goldman Sachs.
I thought it was quite clear that so-called emerging markets were going to become more important to businesses. And so I sort of played around with the idea, and I wrote a piece called "The World Needs Better Economic BRICS," and the rest is history, so to speak.
Eventually, it went on to be popular among the governments of these countries, who held their initial summit and established BRIC in 2009.
The first ever BRIC summit is getting underway in Russia.
In 2010, South Africa was invited because it was a major economy on the African continent. Over time, more countries started expressing interest in joining BRICS. China became a major trading partner and a major foreign direct investor in many countries across the global south. And a lot of countries saw this as an opportunity to elevate themselves geopolitically, as they were not part of other multilateral groupings such as G20, for instance.
BRICS is an inclusive formation that has the ability to change the trajectory of the global south.
4 members joined in 2024, and this year Indonesia joined as well. So now there are 10 countries.
10 countries equals economic power. Look at how the original BRICS have grown compared to the G7 in terms of global GDP since 2009. It surpassed the G7 in 2019. Now add in the expanded lineup, and its share is nearly 40%.
In terms of GDP by purchasing parity, it has overtaken the G7 countries. The trajectory is clear. BRICS countries are growing faster. Their populations are growing as well, for most of them.
This boom in population and wealth has also given the group more political might, which in turn has made more countries interested in joining.
BRICS' main objective is to challenge the established world order, which appeared after the end of the Cold War. Russia is definitely interested in more member states of BRICS, partly to offset its relative diplomatic isolation after 2022.
Power was aided by circumstance. Sanctions imposed by the US and Europe on Russia are one reason why trade among the bloc's first 5 members rose 40% to over $700 billion from 2021 to 2024. Sanctions also contributed to an increasing amount of all this trade being done in local currencies. Look at the red line. That's use of the yuan bypassing the dollar in China's overseas transactions.
China represents more than 35% of Russia's external trade.
BRICS has even talked about a common currency.
Overall, BRICS countries support reduced trade in US dollar as a tool, as a method to reduce overall Western economic dominance in the global economy.
China's influence within the BRICS Plus club cannot be overstated.
China is the biggest, most powerful, richest country in the BRICS group. So the BRICS works as an instrument for China to improve its economic and political power on the global stage.
Since before the beginning of the BRICS, Lula has always been enthusiastic about China. Brazil, under his first presidency in 2004, was one of the first countries to recognize China as a market economy.
Lula realized that China and Brazil had very complementary economies. China wants to have access to a huge consumer market, and it needs food security that Brazil can provide.
This graph shows Brazil's exports to the US. Now we're adding in exports to China. From 2009, China was Brazil's top exporting partner, and now it imports more too. So it's all good, right? Well, there are some hurdles. For Brazil and other BRICS Plus nations, the geopolitics of trade is complicated.
Trade relationships within BRICS are not as developed as, say, within the EU. BRICS is not a trading bloc or group. It wasn't meant to be one. Each country is dealing with the issue of tariffs individually.
Brazil doesn't really want to pick sides. Brazil wants to have the ability to trade with the US, trade with China, with the European Union, all at the same time.
A variety of tensions between different BRICS members have kept the group from forming a united front. But they have managed it with the new development bank, which finances projects across the global south and provides loans with fewer economic and political conditions compared to the World Bank.
It's not focused on advancing Western values and human rights issues in the same way.
Small at the moment, but with potential for growth. So even as the US steps back from its role as a global leader, the disparate nature of the BRICS Plus coalition is its weakness. Although size gives it clout and opportunity, divisions may keep it from bending the global order towards its goals.
I think it's difficult for the BRICS countries to really pursue a joint path on the things that really matter for them collectively, as well as for the world. It's very effective as a symbolic grouping, but how that evolves is probably going to depend to some degree how all their individual economies do, how they perceive the US is moving economically and politically, and how seriously they themselves want to move on big global issues like climate change, infectious diseases, global trade, and so on.
And subscribers can see that Bloomberg Originals documentary on the terminal and on Bloomberg.com. It'll also be up on YouTube a little bit later. More ahead on the Asia trade. This is Bloomberg.
The price of the dollar has nothing to do with a strong dollar policy. Strong dollar policy means several things. One is what is the dollar strong against, or is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world, and we are.
U.S. Treasury Secretary Scott Bessent speaking to us about the dollar's recent weakness. Of course, they're having a lot of concerns about the fading appeal of the U.S. dollar. It continues to linger around multi-year lows. Take a look right now on how it's trading because we continue to see the downside pressure in the Asian session. This, of course, after we actually saw it rise for the first time in 4 days, given that we had another fresh all-time high in the U.S. when it comes to the S&P 500. We also had a stronger than expected June jobs report. Of course, we do have the Trump tax bill also being passed that came after markets closed early in the U.S. session because of holidays. But right now, futures looking to the downside, Haidi.
And of course, what's been going on when it comes to the US dollar has caused that wild ride to continue when it comes to the Hong Kong dollar and the dollar peg there as well. Hong Kong now, the de facto central bank there, being forced to intervene to defend the FX peg for the third time this week, buying the Hong Kong dollar again to defend that foreign exchange peg. 2 previous rounds that we've already seen of intervention failing to send funding costs high enough to dampen bearish currency bets. If you take a look at what we're watching, it really is just the fact that they've bought, $3.8 billion US dollars of Hong Kong dollars in the currency in the New York trading session. It drains liquidity from the financial system. It can increase borrowing costs. So also a more elevated level to the amount of purchases that we saw in the previous 2 purchases this week. So a truly wild ride continues when it comes to the Hong Kong dollar. Well, China's first domestically built aircraft carrier has docked in Hong Kong as part of a drive to drum up patriotism in the city. The Shandong will be open to the public this weekend in what the city's chief executive, John Lee, calls an inspiring visit that demonstrates rock-solid national security. Annabelle Jewellers has more on how the vessel factors into China's broader naval ambitions.
Aircraft carriers are a crown jewel of modern militaries. They enable nations to project power far beyond their shores and act as deterrents by discouraging would-be adversaries from escalating conflicts. Only a handful of navies operate these vessels, with the US having the largest and most advanced fleet in the world. But China is on a mission to catch up. Today, the country has 2 aircraft carriers in active service, the Liaoning and Shandong, with a third, the Fujian, undergoing sea trials. Together, they represent an evolution. Initially, China acquired and retrofitted Soviet-built technology, then progressed to making its own. With both the Shandong and Fujian showcasing enhancements in design and capability. Now a 4th type is in development and could be the first fitted with nuclear propulsion, potentially leveling the playing field with American ships. China wants to become a global Navy superpower, with the Shandong entering Hong Kong waters after another first for the PLA, this time on the tactical front. Both the Shandong and Liaoning were sent to the Western Pacific in June, conducting exercises beyond what's called the Second Island Chain. It stretches from Japan into the Central Pacific and is often viewed as a strategic framework for Washington and allies to contain China during potential conflicts. Beijing's maneuvers beyond this point signal a new phase of operational readiness, with the vessels learning to coordinate in open waters. While such activities are permitted under international law, the show of force is notable. Analysts say the tactic could be used by China to deter US forces in the event it launched a military operation to take Taiwan. Annabelle Jewellers, Bloomberg News, Hong Kong.
Take a look at how U.S. futures are trading to the downside of 0.2%. As we're seeing a little bit of upside for TAIEX futures, we'll continue to follow the trade negotiations between China and the EU. We saw the yuan under a little bit of pressure because of the dollar rebound, but we're seeing the dollar now under a little bit of pressure, so the offshore yuan holding steady. The China show is next. This is Bloomberg.